regardless of how many Bitcoin you have absolutely zero impact on how the blockchain works. Bitcoin is a commodity, an asset without an issuer, just like gold or oil. It's just that Bitcoin happens to be digital. I can talk about Bitcoin all day. I can, buy as much Bitcoin as I can or sell as much Bitcoin as I can. That will not have the slightest impact on the price. Only the person who is the most willing to print money will be the one that will be, elected or selected more.
Bitcoin has been declared dead more times than anyone can count. And yet, here we are, watching it shape everything from treasury strategies to public policy. Today, I'm joined by Thomas Jeegers, CFO and COO at Relai, the Swiss-based Bitcoin-only app, making it easy for anyone in Europe to buy and save BTC straight to self-custody. In this episode, we will talk about what truly gives Bitcoin value, why it's becoming a serious treasury asset, and how its fundamentals stack up in a world where fiat is on shaky ground. Thank you for coming today, Thomas.
Well, thank you for having me.
Let's start with your journey. Before joining Relai, what drew you to the intersection of finance, operations, and Bitcoin?
So already during my studies in economics, I was very interested in a topic that was not so well known and that was a bit in the shadows at the time. That was a concept of complementary currencies. So the fact of having multiple currencies working in parallel in an economy and how that could shape economies to become more stable and ultimately benefit people and the economy massively. This topic did not really come up so much in academia or in the real world, so I decided to just pursue a traditional career in banking. After a couple of years, I became the local expert on blockchain technology at ING in Germany. So it was still really early for blockchain in general, so there was only Bitcoin at the time. You need to imagine that was before Ethereum was out even. And we were one of the few banks who were really looking into it, trying to understand what were the strengths, the weaknesses, and especially what kind of risk it could pose to the banking system in general. I always remember standing in front of the full board of directors of ING in Germany and telling them that $400-something per Bitcoin was grossly overpriced. So I wish I had a different opinion at the time and that I had both. Unfortunately, I have not. But maybe I was right in the sense that at the time, the level of risk that was involved with Bitcoin was so enormous that possibly the valuation that it had at the time was not even justified. Yet it still had enormous potential, and we have seen this potential play out in real life over the decade that followed, and the price obviously skyrocketed from 400 euros at that point in time to what is now over 100k in euros, 120k in dollars currently. Still, so at the time, I was considering too risky. I left it a bit on the side. After my MBA, I looked at it again. And that's when I realized in, let's say, 2020, that things had changed massively around Bitcoin. I mean, it was after the block size war. So after the real use case for Bitcoin had been clarified from within the industry, and the likelihood that Bitcoin would fail had drastically dropped. That's where it really hit me, and I realized, okay, now I need to dedicate my entire time on this. So, not working in the Bitcoin space at the time, I also, I didn't want to drop my career and everything. That was going fairly well. So I decided first to learn everything I could about the topic. Did extensive research, read every book I could put my hand on, watched every video I could find online, and in parallel wrote a book on the topic. So applying my knowledge and background in financial risk management, valuation, and portfolio allocation to this completely new area of, at the time, of crypto in general. And while doing this research, that's when it occurred to me that actually the real value that you can give to any crypto asset actually resides in Bitcoin, not in anything else. And I'm happy to go in more details on why this is the case. And in 2023, in the summer, my book was published by Springer Nature. It's called Understanding Crypto Fundamentals. I wish it didn't have the word crypto in it and was Bitcoin focused, but at least the content is Bitcoin focused for obvious reasons. And after it was published, I decided that now it was the time to really switch and move my career completely, work for a Bitcoin-only company, or even set up an investment fund that would invest in Bitcoin-only companies. That's when I found, when I got to know the people from Relai. Honestly, great people, fantastic company, growing exceptionally fast, and I thought that was the perfect fit for my next step. They also liked my profile, and here we are now, already for over a year at Relai and living a dream.
Before we touch upon the topic of MiCA, I know you've been very vocal about it, and it's really interesting to listen to your opinion about it. May I wonder why Bitcoin is not equal crypto? Because some people still don't know that.
So one of the core value that crypto assets, or let's say even that blockchain technology, is bringing to the table is the concept of decentralization. So before Bitcoin, anybody who would want to send money to somebody else needed to go through an intermediary, one or several actually. I'm asking my bank to debit my account by 20 euros. The bank is going through the SWIFT payment network, so more intermediaries, going to your bank and asking your bank to credit your account with 20 euros, and they each, balance out their book. All that needs to be coordinated by a central bank and by, a full network of intermediaries that just make an agreement on who has how much money. Now, obviously, this comes with a cost to make that happen, cost in terms of freedom of speech. If one of the intermediary decides that he doesn't like you or me for any reason, they can decide to block the transaction. Unfortunately, that has happened and is still happening to countless people all over the world. Banks can choose not to bank many people. There are literally several billion people in the world who do not have access to a bank account, either because they are living in places that are too remote or because they are not wealthy enough to be interesting targets for the bank. And, it comes with a series of unfortunate consequences, the fact that you have intermediaries. Now, with Bitcoin, it changed the game completely. You had for the first time the ability to transfer digitally something that is scarce in a decentralized way, so without any intermediary. And this, let's say, public infrastructure for payment is really the new thing that Bitcoin brought to the financial ecosystem. I'm saying public infrastructure in the sense, so it's public in the sense that anybody can join the Bitcoin network at no cost, can start receiving Bitcoins immediately, even without having access to internet. You have an address on the Bitcoin blockchain, you can receive money anytime, without any barrier to entry, without anybody to assess whether you are worthy enough, whether they like your political affiliation, skin color, your nationality, or any criteria. It's literally something public, accessible to everybody. So the same way internet is public infrastructure for sharing information, Bitcoin is the first public infrastructure for sharing value. Now, why do I mean value? Because you could have, before, you could share, let's say, cash, that's sharing value, or you could share any good, you could exchange them. That's also sharing value without needing intermediaries. But Bitcoin makes it for the first time feasible without intermediaries digitally. So before Bitcoin, you had the choice. Either you can exchange value with somebody, but it cannot be digital, so without intermediary. Or you could exchange value digitally, but it needed to have an intermediary. Now, Bitcoin, for the first time, makes the two of them possible. So that's the core value of blockchain technology. What it brings is it brings the possibility for a decentralized exchange. Yeah? And I'm insisting on the word decentralized because this is absolutely fundamental. If you have a company using blockchain, but in a way that is centralized, well, you remove the only reason why you would use blockchain in the first place. If you have a foundation or a company emitting a token that can say, well, we will give more token to that person, or we'll change the rule of how the token works, or we will ban these people from holding the token, well, then you lose all the benefits of this decentralization. It's not decentralization. You lose all the benefits of using a blockchain in the first place. Now, Bitcoin is decentralized in the sense that not a single person in the world, not a person, not a group, not an institution, not even a government, can stop it. In order to prevent the Bitcoin blockchain from continuing its operation, you would need to prevent all the people in the world to stop using the internet at the same time and forever. Literally, as long as you have two computers connected to each other, the Bitcoin blockchain can continue to exist. And when internet comes back, well, it continues to spread around the world exactly at the point where it left off. So there is no way to stop it. Yeah, the same way you cannot change gravity, well, you cannot prevent the Bitcoin blockchain from being able to expand. We also saw that there is not a single person or even group of people who have the ability to change the way how the Bitcoin blockchain functions. They cannot change the maximum cap. They cannot change how many Bitcoin are rewarded per block being mined. They cannot change, just name it. The protocol, the key features of the protocol are immutable. And I mean, to change them, you would need to have such an agreement about so many tens of thousands, if not millions of people to agree to make a change that, it's just next to impossible for that to happen. It's like if you were trying to change the rules of chess, you need to convince every chess player in the world to start playing now with 3 rooks instead of 2. Well, good luck with that. There is a set of rules that everybody agrees on, and now this is how the game is being played. Bitcoin has proved that it is immutable. Its core features of the protocol are immutable. Even in the block size war that I already mentioned, so in the years 2016 to 2018, you had several very influential people in the Bitcoin ecosystem who were trying to change the size of a block on the Bitcoin blockchain. So it was a war between what we call the big blockers and the small blockers. So big blockers were trying to make changes to the protocol. And by the way, they were very established, very respected Bitcoiners that everybody was, or a lot of people were admiring at the time. And they definitely had influence. And despite giving their best trying to change how the Bitcoin protocol works, they failed at doing so. Well, they think it's very unfortunate for them because they had a different vision for Bitcoin. But what it did is that it told the entire world that even when the most influential people in the Bitcoin ecosystem are trying to make a change, even them are not able to change anything, even as they had, a large group of followers and everything. And it just proved how resilient the Bitcoin blockchain is to changes. It proved that Bitcoin is genuinely decentralized. Now, compare that to any other crypto asset. And I will take the one that is probably considered by all as the second most decentralized, which is the Ethereum network. Well, Ethereum had a dozen of protocol changes over the last few years. It even changed things that are so fundamental to how it works, like moving from proof of work to proof of stake as consensus mechanism. And there are even historical events that prove that the Ethereum blockchain was absolutely not decentralized. For example, when there was this famous decentralized autonomous organization, the DAO, there was a hack in the relatively early days of Ethereum, and they managed to hack something like 1/3 or even 2/3 of all the ethers in existence were hacked and moved to another address. Well, Vitalik Buterin, the leader of the Ethereum Foundation and co-founder of Ethereum, unilaterally decided that this is not what Ethereum should be, and therefore they rolled back the chain, so the blockchain of Ethereum, and decided to go back in time as if the hack had not happened. Well, it makes us, smile and laugh today to even think of that possible, but that's really what happened. And he basically showed to the entire world, pretending, oh, we are decentralized, but unless there is an event that I don't like that happens, and then we all decide that event did not happen, we roll back and we do as if it did not happen. So basically he proved that it was not decentralized. And then that has been proven over and over again with multiple protocol changes, including the most important one, the move from proof of work to proof of stake. So as part of what they call the merge event. The problem with a proof of stake based system is that the more you have at stake, so the more coins you have, the more power you have on the protocol. Let me explain that. In a proof of stake system, if you have more at stake, you have a higher likelihood of validating the next block on the Bitcoin blockchain. On the Ethereum blockchain, obviously, or on whichever blockchain you are using with this proof of stake mechanism. This contrasts completely with a proof of work system like Bitcoin uses, where regardless of how many Bitcoin you have absolutely zero impact on how the blockchain works. You have zero impact on what will be the next block mine, and you definitely do not increase your likelihood of mining the next block, because the amount of the coins that you have is completely independent from the amount of political power that you have. Political power in the sense of your impact on the underlying protocol, your ability to validate or to mine the next block. So Bitcoin beautifully separated these two things so that rich people are not influencing those who mine the Bitcoin blockchain or who decide how the protocol works. Ethereum, unfortunately, merged the two, and it came from good intentions, saying, oh, we are making the chain more so we can modulate it better, we can put more stuff on it and so on. Well, it ignored the conflict that it creates, the inherent moral hazard that this creates. If you have more coins, you have a higher likelihood of validating the next block, therefore of getting the block reward, and therefore of becoming even more wealthy. So in other words, the wealthier you are, the wealthier you get. Completely different from Bitcoin, where you can be wealthy, well, good for you, but you still have zero power on the blockchain. All this to come back to the fact that decentralization is ensured through, among others, a meaningful consensus mechanism where the political power is independent from the ownership of the coins. So in proof of work, you will maintain this. So it's one of the criteria that will suggest that you will maintain decentralization because it is not linked. While in proof of stake and all the consensus mechanism that come from it, you will have a tendency of concentration of coins over time in fewer hands. So by design, you will become more and more centralized over time. So a proof of stake coin cannot work in the long term. It can work for a few years. It can work with pseudo decentralization, in the sense it's not purely one unilateral decision by a single ruler, but over time it will go in that direction. So unfortunately, that's one of the big flaws of all the models that are on proof of stake, and unfortunately, that's most of the blockchains are on proof of stake. Now, Bitcoin and a few dozen others are on proof of work, and proof of work is really a winner takes all game. When you have so Bitcoin benefited from being the first mover in the game, so they have this clear first mover advantage. As they increased and gathered a relatively high level of hash power, so basically how much energy is running in order to secure the network, so that it was well ahead of any other protocol that was using proof of work, and ultimately, became the only one that mattered, not only in terms of market value, but also in terms of hash power, in the sense that Bitcoin has more than 100 times more hash power than all the other proof of work coins together. Yeah, so
and that's as for the operational efficiency, basically. In this.
Well, there are multiple reasons. One is logical. If you have such an advantage of being so much bigger than any other coin, and you have, let's say, coin number 2, let's say a mini Bitcoin, so a fork, who tries to run a similar algorithm, well, you just need one big miner from Bitcoin to decide to break the small one, and he just moves his hashing power to the small one, and all of a sudden he has way over 50% of the hash power of the smaller blockchain, and therefore he can decide how the protocol goes. He can, for example, decide now all the future coins are going to me.
No decentralization whatsoever.
Exactly. So you are in a situation of pure centralization. Yeah. So it's really only the winner of a proof of work system that will take all the value for itself.
So there is no second best?
Well, clearly there is no second best, quoting Michael Saylor on this. It's just the incentives are such that you will only go for, so you will go away from a proof of stake like system, and proof of work is a winner takes all competition, and there you logically conclude that actually all the value flows into Bitcoin, not into any other coin. Hence the reason why I was looking for a Bitcoin-only company, or looking to invest in exclusively Bitcoin-only companies, why Relai is Bitcoin-only, while most of our investors are investing exclusively in Bitcoin-only companies, and so on and so forth. So there starts to be this realization that actually you have Bitcoin, and then you have everything else that are more like, small, semi-centralized projects. Look, I'm not saying that they have zero value, but I'm saying that they may have as much value as a small company that is launching a centralized token, but you should not call them decentralized, because it's not the case. There is one asset that is digital and decentralized. It's called Bitcoin. This is the one and only, and it is also likely the one and only that will ever be decentralized, because the incentives on its blockchain are for further decentralization, while the incentives on virtually all the other blockchains are for centralization over time.
MiCA was supposed to bring clarity. In your opinion, what's happening on the ground across member states and of EU? And what does that mean for CASPs?
So first of all, for the audience, let's start with explaining a bit the background. So in the financial industry, there was this big regulation called MiFID, so Market in Financial Instrument Directive, that was defining basically how financial instruments of all kinds were supposed to work. Now, regulators rightly identified that Bitcoin and crypto assets did not fall strictly into the the concept of MiFID, and that they needed different rules if they wanted to regulate it. Now, there was a call for regulation, and people are talking in sometimes very good ways, sometimes very bad ways about regulations. I have more of a mixed feeling about this. So excess regulation is obviously helping no one, but no regulation at all might be dangerous and might not be helpful. And so some kind of regulation can provide regulatory clarity and give a certain level of trust from the entire industry into the proper functioning of the capital markets and financial market that are covered. So MiCA came actually from good intentions. They genuinely tried to give some regulatory clarity around the entire crypto asset space and to protect consumers. That's one of the key goals that many regulations have. It's always protection of customers, making sure that they are not being scammed, which unfortunately in the crypto space is very ripe. There are very many ways to scam people, and as with every technology, some bad actors have taken advantage of it. So it came from good intentions. So the EU created this enormous piece of regulation. I'm talking here about several hundreds of pages with a scope that is absolutely enormous. It covers, Bitcoin, all of the crypto assets. It covers stablecoin. It covers definitions of everything, all the ways how you can trade from one to the other, and what kind of rules are supposed to exist for every type of transaction, for custody, for just everything. There are some bad parts about MiCA that I will not touch. So let's not touch the how MiCA has basically pushed the stablecoin business offshore, so that all European users can basically not make use of, for example, Tether, because MiCA has imposed insanely high threshold for stablecoins. Let's focus rather on how Bitcoin is regulated via MiCA. So again here, MiCA is trying not to regulate Bitcoin itself, which makes no sense. I mean, you cannot regulate the chain itself because, as I was saying, it's a public infrastructure. There's no way to change the protocol. You cannot regulate the protocol. But it regulates all the on-ramp and off-ramp. So basically any company like Relai that offers the ability for users to get into Bitcoin or get from Bitcoin back to fiat currencies. As I was saying, MiCA comes from good intentions, but unfortunately there are some very bad consequences that came out of it. One of which is that in order to be MiCA compliant, you need to have such an enormous compliance and legal team that it basically gives the monopoly for MiCA compliance to only big players. Fortunately, Relai came in at the right moment, was properly funded, and we have an excellent team, including my teams in compliance and legal, that enabled us to be at a stage where we can claim compliance with MiCA. Just for transparency, we have not received the MiCA certification yet, but I do expect this to arrive relatively soon. So as I was saying, only relatively big players can have even a chance of having their MiCA certification. It means that any small, innovative fintech trying to, offer new innovation to the market, but for which they would need to be MiCA compliant, to be allowed to operate, well, they have just next to no chance of ever being able to cross that threshold. Literally, it takes years to get to a level of MiCA compliance. I'm saying this because we have seen that our application was submitted more than a year ago, and we thought it would be relatively straightforward, and it turned out to be a regulatory nightmare, like a labyrinth to go through. And we just have seen how extremely difficult it is, and how much of a barrier to entry this is setting for all the other potential players. So despite the fact that it came from good intentions to protect the customers, actually it is stifling innovation massively. So now new players can barely ever hope to be MiCA compliant unless they are backed by millions upon millions of funds to be able to operate for a very long period of time, many months, possibly years, in order to get their MiCA license and then be able to launch finally their product on the market.
What do you think regulators don't seem to grasp about how crypto services work and operate?
Well, one of the limitations of MiCA is that it did not differentiate, let's say, Bitcoin from altcoins. And as I mentioned, they are fundamentally different instruments. Bitcoin is a commodity, an asset without an issuer, just like gold or oil. It's just that Bitcoin happens to be digital. It is an asset that does not have a central point to emit it.
That's why it's regulated by CFTC in the US, not by Securities and Exchange Commission.
In the US, it's a bit different, but the concept behind it is critically important. You have a commodity, while all the other assets cannot claim to be an asset without an issuer. You have a very clear issuer. You have, in most cases, a very clear CEO. They are not commodities, they are securities. Securities come with completely different incentives and ethical concerns. If you are at the head of, I will try not to say names for this video, but at the head of an altcoin company, and then you decide, well, you know what? Now let's give half of all the tokens to our own employees. You can do that. But basically, this is taking value from all the investors in the token and to give that to a centralized group of, a selected few in a way that is absolutely not, agreed or voted, or typically not agreed by all the investors.
You lose trust as well along the way.
Well, you will progressively lose trust, indeed. Well, for Bitcoin, obviously that cannot happen. The protocol is open source. Everybody can see it. You can download it. You can save the entire Bitcoin blockchain on an SD card, not bigger than the nail of my thumb. You have all the information that you need about Bitcoin that is minimal in size, fully transparent. And obviously, there will never be somebody saying, oh, now I'm taking half the coins, or I'm taking that fraction, I'm giving it to somebody else. You cannot do that because the protocol does not allow for that. That's what I mean. There's a difference between commodities and securities. It's not a legal difference that I mean, it's an ethical difference. One has incentives. The security has incentives that will be biased. The other one is just, there's nothing that will justify a change in the protocol. There's nothing that will create this conflict of interest by the people behind the protocol, because there are no people behind the protocol. The whole concept of decentralization. And this is something that the MiCA regulation fails to see so far. They have not differentiated Bitcoin from altcoins. And last week, for example, we had an answer from our regulator that we needed to set up, like everybody else, like all the other CASPs, we need to set up a market abuse policy. It's just because they know it's not relevant for Bitcoin, they know it's not relevant for Relai, it's just that it's standard for all the crypto asset service provider CASP. A market abuse policy means that you need to be able to prove and explain exactly what you are doing so that there is no, conflict of interest. In the case of an altcoin, well, that makes sense because indeed, you cannot just choose to create more units of the token and give them to yourself. So, or you need to be able to prove that you are not able to massively influence the price and therefore benefit from arbitrary fluctuations on market price. So that makes sense for altcoins or for anything that trades anything else than Bitcoin. It makes no sense for Bitcoin. Obviously, there's nothing that I can do that will influence the Bitcoin price. I can talk about Bitcoin all day. I can, buy as much Bitcoin as I can or sell as much Bitcoin as I can. That will not have the slightest impact on the price. So there is no market abuse possible with a globally accepted, decentralized commodity like Bitcoin. And this is one of the limitations of MiCA policy. So failing to differentiate between Bitcoin and altcoins.
Some people think that AML and KYC requirements are doing more harm than good, right? And I think you are one of them as well. Could you please walk us through the core issues?
Yeah, sure. So AML KYC, so abbreviation for anti-money laundering and know your customers, are processes and requirements that any bank, any financial institution in general, needs to set up in order to know where funds are coming from, where they are going, to a certain extent how they are being used, to ensure that the funds are not used for money laundering purposes. And again, like many regulations, it comes from a good place. It was genuinely, good intentions. You do not want your money to end up financing terrorism. You do not want your money to end up, supporting a totalitarian regime that prevents people from having freedom of speech or anything like this. You want, to provide a service to people like you and I who are trying to go around their day, provide for their family in a perfectly legal way. So they set up these rules, but as before, there are unfortunate consequences for that. First, let's imagine that you are trying to do some kind of money laundering. Well, these AML KYC rules will not prevent you from doing your money laundering. There are countless ways in which you can do money laundering, and it's impossible to close all the doors. As every time you try to close a door and exit route for money laundering, there are, people are opening 3 more. So it's an impossible task to prevent that from happening. So any person who is trying to do money laundering will manage to find ways to do that. So what is the other side of the coin? It's all the people who have no intention of doing any money laundering or financing terrorism whatsoever. They are required to provide extensive proof of their identity, so losing all the privacy, proof of their address, proof of source of fund, how you got wealthy, just every document you can imagine, which unfortunately not everybody has. There are countless people who do not have access to, for example, an ID. Literally 1 out of 4 persons who are born today do not have access to any proof of identity. And therefore, they will never be able to go through a KYC process, and therefore they are refused banking services. So, and let's not ignore this. We are not talking about a small fraction of the population. We are talking about a very large amount of people, and typically people that are already in desperate situations in countries that do not have, let's say, the securities that we can benefit from in Western societies. People that are at risk of being exploited in countless ways. And they are the ones to whom you are basically refusing to give banking services in general. So it's not limited to crypto, it's for all banking services. So that's why it's actually, the dark side of KYC. Now, actually, I would say it goes even much further than that. Because once you gather the KYC from, let's say, 1 million different customers, you literally know who they are, where they live, how much they have on their account. So you know exactly who are the wealthy ones. You know basically everything about them.
In some cases, they are asking for the statements and those statements aren't just about how much money you have on your account, but what were your transactions for the last, not even a couple of weeks, right? But actually longer, which is kind of a breach of privacy, I guess.
It is definitely an attack on people's privacy. So you are creating this database of KYC that becomes a honeypot for any hacker. And there is no private system in the world, any private digital system in the world that is absolutely 100% hack-proof and future-proof. Even if you can prevent most or all the hacks that could happen today, you do not know what kind of new ways to hack will appear next year or the year after.
I was writing I was doing a small research on Pegasus. There is such a software developed by one cybersecurity company. And so the core thing about this, the most interesting part about it is that literally no messenger, if it's whether it's Signal or whatever else, whether it's encrypted or not, is safe, because you can, or your phone, for instance, and so on, you can get just one message, one SMS, and your phone sends all the information to whom needed, right? In this case,
so that's a precise example of how data can be hacked and extracted and shared or sold with the wrong people. And by doing KYC databases, by forcing every single provider from having a full KYC about all the users, you are creating a honeypot that is exactly what hackers are looking for. So now there's a hacker who manages to infiltrate, even if 99% of the service providers are safe, he managed to infiltrate one of them who has data about everybody, and now all of a sudden you, the perfectly normal person who has just happened to say 50 euros every month in Bitcoin, well, now all of your data are shared with a person that you really do not want to have all of your data. That hacker can then use all of your data to impersonate you and do KYC for any other platform, and then take advantage of the fact that that the platform will think it's you because they have all of your data, all of your documents, and then you go into much bigger possible troubles. So, in conclusion, KYC, first of all, it is not preventing money laundering from happening. And secondly, it is possibly making things even worse by providing honeypots for hackers to get into and then impersonate the people that the companies were supposed to protect in the first place. So it is, as I said, a regulation that comes from good intentions. I'm not saying that those who drafted it were evil or something. That's absolutely not what I mean. They mean good. They mean customer protection. But unfortunately, the second order, third order effects can be extremely negative. And it's absolutely terrible for the privacy of people.
Do you think some alternative models strike a better balance between privacy and compliance?
So Bitcoin is obviously not completely private. It's not anonymous. It is pseudonymous. Yet, anybody in the world can create an address at no cost, which is just a string of 64 hexadecimal characters. So just a long string of 1 and 0s, and can start receiving real value on it. And you can create as many addresses as you want. So in that sense, you benefit from some kind of privacy. But the functioning of how the Bitcoin blockchain works is that all the transactions are public and all the funds on any address are public. So if you receive money from somebody, well, they will know exactly how much money you have on that particular address. And then if you send that money from your Bitcoin address and you combine it with another Bitcoin address of yours, well, they will know that this other address is likely yours as well. And, then you can start to infer who is behind everything. So it's not anonymous, it's pseudonymous, but it's providing some kind of privacy to a certain level, a level that is, from how I see it, acceptable for regulators. It's not like a Monero that provides you with full anonymity, and that is definitely something that regulators do not like. So it's providing you some privacy while at the same time making it in a way that, if there's a clear terrorism financing organization behind an address, well, with sufficient on-chain analysis, you will figure out who it is. So I believe that Bitcoin is actually hitting the right balance here. And if you really want privacy, there are ways to increase your level of privacy on the Bitcoin blockchain, some kind of digital hygiene of how you're transacting in order to maintain a higher degree of privacy, at least for relatively small transactions. You can do that with thousands of Bitcoins, but with relatively small transactions, you can maintain a relative privacy, because honestly, it's none of anybody's business where you bought your coffee today, or what kind of books you're buying, or whatever. It's none of anybody's business. So that's the kind of privacy that it provides you.
Let's zoom out. What worries you most about Europe's regulatory direction?
Unfortunately, the European Union is going into a direction of trying to regulate every single aspect of your life. So first of all, it's pointless because it's impossible. And secondly, it is a slippery slope to a completely totalitarian regime, because the only way to prevent you from doing anything that I don't want you to do is to control everything about yourself. So unfortunately, this over-regulation is a slippery slope to less liberties, to less freedom of speech, to less of everything. Every human right that you would think naturally that this is something good to have. So more freedom of speech is good to have. More freedom of transaction, more freedom of movement is a good thing. Well, it is restricting you precisely for these things, and unfortunately, there is it only goes one way. So again, I'm not saying that all regulations are bad. I'm saying that there is a balance to hit, and that currently we are way past the optimal point, regardless of where you think the exact optimal point is. We are like orders of magnitude beyond it, and it's going further away from the optimal line.
How do you think this affects startups and builders in the space?
Well, actually, it's really clear how it affects startups and builders. It becomes extremely costly to innovate. In a well-functioning society with minimal regulation, you would be able, you have an idea, you're able to launch within, a few days, weeks, and test it on the market. If it takes, you continue, and if it does not, well, you move on to something else. That's how innovation starts. It's not, I'm working for 2 years on a business model, then I'm trying to raise funds without having any proof of concept. Yeah, then if, it's a big if, but if I manage to get enough fund to launch that, I need to work for 1 full year to become compliant with whatever license I need to get to go there, and then launch something to only realize that actually there's no demand for it. And by the time you have done all that, well, the market has evolved and your idea is not worth anything anymore. So that's not how innovation works. Innovation should be, fast, and people should be able to launch things without having to think about 1 million different things, without having to have a full 10 people compliance team working full time for a year in order to get a license to be able to launch. So unfortunately, too much regulation is just killing innovation, whether they like it or not. And you cannot regulate people into innovating.
Let's talk about inflation, especially in light of recent central bank behavior. What can help us understand Bitcoin's appeal as a hedge and why?
People typically define inflation by its consequence rather than by its cause. So the consequence of inflation is that price go up. The cause of inflation is the money supply, so growing. Literally, price go up or down. They do not inflate. It is the money supply that inflates. So actually, the equation is rather simple. The more money you create, the more prices will go up. If you want prices to go down, you need to have more innovation. You need to have people becoming more productive, But there is a certain, let's say, you have a pie, which is the economy. How much money you create is in how many slices you cut the pie. If you create twice as much money, well, you just slice the pizza twice as much. You do not create more pizza. Any amount of money that is sufficiently divisible is sufficient to accommodate any economy. I'm not saying that 21 million units is the right amount. 42 million or 1 billion would have been just fine, as long as it is sufficiently divisible and as long as that number is not changing. This is what matters. Unfortunately, in traditional Keynesian economics, which are based on completely flawed foundations, they push for, there should be a central bank that produces money, that has the monopoly on creating the currency, and that should create 1%, 2%, 3% more of the currency every year, which is nonsense. You do not need to create more money. That has no purpose. What you want is to have a monetary policy that is reliable, something that people can trust. So obviously, 3% inflation is better than 10% inflation, and 2% inflation is better than 3% inflation. But still, at a 2% inflation rate, well, it means that €1 that you have saved is worth only half as much in about 35 years. At a 10% inflation rate, it's worth only half as much in only 7 years. So you do not want the money that you save to be worth less every year. I was saying for 2%, it's 35 years, so it's basically one generation. So if I want to leave $100 or €100 to my grandchildren, well, by the time they reach my age, well, so for every dollar that I have saved, it will only be worth 25 cents. If the money supply only increases by 2% all along. Unfortunately, it's even more than that. So that's the first reason why actually inflating money supply has no reason to be. Now, secondly, it creates perverse incentives to give a person or an institution the ability to create more of the currency. The chairman of the Federal Reserve or of a central bank will always have incentives to print more than more than less. Because if you print more, then you can remunerate your employees better, you can just give yourself a bigger share, you can give your government a bigger share, and so on. And if you don't print more, well, you will quickly be replaced by somebody who is willing to print more. So I'm not saying that any person who is in charge in any central bank is evil by itself. I'm saying that the incentives of the system are such that the most evil you are, the more likely you will be to be, leading a central bank, because only the person who is the most willing to print money will be the one that will be, elected or selected more accurately, will be the one selected to be in charge of the money printer. Because there are always political incentives. If you have two political parties, one is claiming that he wants to have a healthy monetary policy, a healthy, level of debt, and then you have the other party who is promising you free stuff, free of anything. Let's just give free housing to everybody. Let's just give free food to everybody. Well, it will, a lot of people will want the second party to be in power, and therefore that's the party who has the higher willingness to print that will end up in power. So the incentives are just wrong. No institution should have the ability to print, because otherwise this ability will be used. If not in the first 4 years or in the first 8 years, it will be used eventually, and it will be the collapse of the currency eventually. This is not an if, it's a when, by design. So unfortunately, until recently, we didn't have any better alternative to central banking in a digital way. So I'm saying in a digital way because we had gold, but gold has the limitation that it's not digital, making it, let's say, a burden for many purposes. But now we finally have something that is digital and that has a fixed supply in a decentralized way. And so you remove the ability to print, so you remove the perverse incentive behind the monetary policy.
We have seen a rise in companies putting Bitcoin on their balance sheets. What's driving that trend?
Bitcoin is basically digital capital. Bitcoin is the ability to save value in the digital space over a long period of time. If you have cash in dollars, Swiss francs, pounds, euros, it is not a store of value, because the inflation we just discussed, also because there are restrictions on its usage in some cases. But Bitcoin enables you to transfer value from today to the future, and that whether you are a person, a company, an institution, a government, a non-profit, it doesn't care. Bitcoin doesn't care what you are or who you are. It just does what it does. So it stores value over a long period of time. Over a short period, it can see some fluctuation, some volatility, but over a long period of time, it, for the past 16 years, has always gone up. Now, a company obviously wants to do that as well. That's the base case for companies to invest into Bitcoin. At Relai, we have currently 47 Bitcoins on the balance sheet, and we enable countless companies, typically small and mid-sized companies throughout Europe, to invest in Bitcoin via our services. We are seeing a trend that is also very different from that. It's large companies investing massive amounts in Bitcoin. So first, there is regulatory arbitrage that is taking place. We have seen that first with MicroStrategy, now called Strategy, so the company of Michael Saylor, which got an enormous amount of Bitcoin on its balance sheet compared to the size of its operations, such that the stock price of MicroStrategy started to follow exactly the price of Bitcoin. Basically, people were pricing MicroStrategy on its balance sheet, not based on its future cash flows, on its operations. And it's a good reason for that. It comes back to the reason of regulatory clarity that I was mentioning earlier. If, as a company, 4 years ago, you were trying to get some Bitcoin, well, you would have needed dozens and dozens of meetings, hundreds of pages on how you're going to do that, how are you going to custody it. You would have never passed it in front of by shareholders. Your board would probably have been in the way, so it would have been a nightmare. Now, if you are instead just investing into stocks, well, that is just usual business. And there were many companies who wanted to have exposure to Bitcoin that couldn't do that from a regulatory perspective, and therefore they were buying MicroStrategy as a proxy. So MicroStrategy went up in price, and as Bitcoin went up, MicroStrategy accumulated more Bitcoin, and so on. So that was the phase one of being a Bitcoin treasury strategy. Now, what we are seeing for the past, let's say, year or so, we are in a completely different phase. We are into redefining capital markets. So capital market, especially fixed income markets, so bonds, face what is typically called the yield curve. So I promise to pay you, 1,000 euros in 1 year with so much interest. Well, how much do you buy this? So for how much do you buy this promise? What if it's in 2 years? What if it's in 5 years? What if the interest rate is higher? You can buy this promise. Yeah, that's basically the yield curve. So you buy the promise for a future fixed amount at a specific interest rate. That has always been backed by your company, its operations, and in some cases its balance sheet. Now, Bitcoin is giving a completely different vibe to it. First, I can make promises to repay in Bitcoin. I can even if I make promises to repay in fiat, I back that promise with the future price of Bitcoin. And basically what, again, naming the leader, MicroStrategy, what they are doing with a set of fixed income instruments is to create a Bitcoin yield curve. So all these promises that I mentioned, well, MicroStrategy has created different instruments, Strike, Strive, Stripe, and now Stretch, which are all different durations, different level of interest rate, different seniority, therefore different risk attached to it. And then you can see the market price these instruments in real time. And what Michael Saylor is creating, he's creating a yield curve for Bitcoin-backed fixed income instruments, which is something that takes a bit of time to get one's head around. This is not straightforward, but this has enormous value for financial market. It is basically creating different types of instruments behind Bitcoin and enabling then the companies behind it to create then derivative products behind it and so on. So create a full financial architecture around Bitcoin. This was one of the logical steps in Bitcoin becoming mainstream. So it is the financialization of Bitcoin on Wall Street.
Can you share examples of recent treasury adoptions that stand out to you?
So on the global scale, you have, of course, the big ones next to MicroStrategy. You have 21 Capital. You also have operational companies that turned around, like MetaPlanet in Japan. You have Semler Scientific, and you have some big ones coming up on every jurisdiction. I know there's a big one in Korea and so on. So basically, any company that is publicly traded can benefit from an advantage of having a Bitcoin strategy, because the market will value the Bitcoin, and depending on how you are building it on your balance sheet, you can actually get a leverage to that, and your valuation will increase by a higher ratio than the ratio of the Bitcoin on your balance sheet. So that's from a general global level. Now, what I think is very interesting to see, for example, here in Europe, is that there are plenty of small cap, not even traded, of like small and medium-sized companies that are starting to buy Bitcoin for their own treasury, even if we're talking about fractions of Bitcoin. People like, accountants, dentists, construction work. We have gold companies, so several gold companies, so either traders or doing different things with gold, that do realize that they need to hedge the value of their gold with the new gold, the digital gold, that is Bitcoin. You have interesting cases like real estate companies, because they know that they need to invest for the very long term. If they build houses, they know that in 25 years they will need to renew the roof of the house, and therefore for every house they build, they will buy a certain amount of Bitcoin, because they know that they don't care about the volatility, but over a 25-year period, this small amount will most likely be able to cover for the renovation in the long term. So they are basically buying long-term insurance in value. So again, a store of value function with Bitcoin. And I think this is really the most interesting cases, people who understand that if you are setting money aside for the long term, well, the best way to do it is with Bitcoin. It's more liquid than any other instrument. It's, if you want to use houses, real estate, to store value over a long period of time, well, it's not really liquid. You cannot cut it in small fractions. You cannot just sell the living room of the house to get some money. And it takes a long time to sell a house. You have plenty of problems. And if you want to do it through a real estate investment trust, REIT, that benefits from higher liquidity and more fractionalization, well, you also have fees to pay. So there are always trade-offs to make. Now, Bitcoin gives you the best of all worlds. It provides you with the long-term capital appreciation, long-term store of value, but it provides you with the liquidity. It provides you with the fractionality, so you can sell 100,000 of a Bitcoin, and so on and so forth. It provides you really with the best of all worlds, and it's a new financial instrument, a new tool that everybody has at the tip of its hand to make advantage of, to deal with the world.
How could this shift toward Bitcoin treasuries help anchor long-term financial stability even beyond individual companies?
One of the things that Bitcoin shows is that if you want to store value for the long term, you cannot do that in fiat currencies. So progressively, people will evolve towards more Austrian economics, so basically real economics, where you understand that the value of your work does not need to be eroded by 2% every year. There's no reason for that. You can store the value of your work. And as these treasury companies continue to grow, they are providing more trust, more support to the Bitcoin economy that will eventually replace a fiat-based system, so replace the monetary system. This is not something that happens overnight. This is something that happens over decades, and we are seeing it evolve at an absolutely mind-blowing pace. But these treasury companies are just one piece of the puzzle that are contributing to a healthy, complete Bitcoin ecosystem.
Is there a tipping point at which holding Bitcoin on a company's balance sheet becomes the norm rather than exception?
Well, we are seeing more and more companies put more and more Bitcoin onto their balance sheet because, like everybody, they want to store value. I feel like I'm always saying the same, but this is really the key function that Bitcoin provides. And do you want to store the value of your work for the longer term? Regardless of whether you are a person, a company, or an institution, the answer will most likely be yes. And therefore, you will automatically move to Bitcoin. So it's happening, as they say, progressively and then suddenly. And there will be a point where it will accelerate even further, and then it will become the standard.
Let's address the environmental elephant in the room, Bitcoin mining. What do critics get wrong about it?
All right, I love that one. So Bitcoin has often been criticized as being bad for the environment, while it's actually it couldn't be further from the truth. And let me explain why. Yes, Bitcoin uses energy to secure its network. However, the incentives for which energy to use are so that you would only use energy to mine Bitcoin only energy with which you cannot do anything else with. For example, the light that we are seeing here, it probably costs 35 or 40 cents per kilowatt hour. Well, to mine Bitcoin, you need to be able to tap into energy that costs you, I think actually we're at about 2 cents per kilowatt hour. So you can definitely not use electricity from the grid, from the plug on your desk to mine Bitcoin. That, I mean, you can, technically it would work. It's just that in order to make 100 euros, you need to spend probably 800 euros of energy. So it makes no sense. What makes sense is, for example, to use energy that you cannot do anything else with. And let me take an example. Imagine you have a hydro power plant on the Danube. During the day, about 8 hours a day, you can sell the energy that you produce on the electricity grid of the city of Vienna. And you sell it for, 35, 40 cents per kilowatt hour. About 8 hours a day, you are barely breaking even. And during the night, as just next to nobody is using electricity, you actually, the water continues to flow and you continue to produce electricity, but you cannot do anything else with this electricity. Actually, it's even worse. Currently, you need to pay in order to get rid of the electricity because you cannot store it. It needs to be used right here and right now. So now these hydro power plants, what they are doing is plugging Bitcoin miners on their hydro power plants, and as soon as the demand on the grid becomes zero, so when you cannot do anything else with this electricity, well, they start powering the miners which start mining Bitcoin. So not only are you not wasting this energy, you are not paying to get rid of it. On top, you are actually making a benefit from using this energy. Now, if I'm the owner of the hydro power plant, I go from being profitable 8 hours a day to being profitable 24 hours a day, just thanks to Bitcoin mining. What do you think I will do? Well, I will build 5 more hydro power plants. So not only will I have even more electricity to mine Bitcoin when there is no demand, but on top, during the day, I will have created 5 times as much electricity to power the electricity grid of the city of Vienna. So that not only is it that the percentage of renewable energy to mine Bitcoin is going up over time, but even the percentage of energy being used in general for anything, to power this microphone or for this light, this is more and more renewable energy thanks to Bitcoin mining, because Bitcoin mining is providing an incentive to create more renewable infrastructure. So if you care about the environment, if you care about the transition to more renewable energy, the best thing you can do is being pro-Bitcoin. And that's precisely why we are seeing so many renewable companies now go full on into Bitcoin.
There were studies proving that Bitcoin mining actually supports them at the pre-commercial stages as well. And as you mentioned, during the main operation stages too. So I'm also on that side, on that front. Bitcoin mining is actually good for the environment.
Absolutely. Without a shadow of a doubt. You have even the large majority of the peer-reviewed paper on the topic show you that the net effect of Bitcoin on the environment is a net positive, and actually is possibly the best technology in existence to help the energy transition. So the critics thinking, it uses energy, therefore bad. Well, no, it only uses energy that is stranded, so that is otherwise useless, and actually provides incentive for creating more energy, and especially more green energy.
Central banks are pushing CBDCs. What do you see as the core risk of central bank digital currencies?
So CBDC are solving one of the problems of fiat currencies, is that the problem of having so many intermediaries. However, it's also putting so much power in the hand of a single individual, a single institution, that the risks are actually much larger. So people are even sometimes comparing Bitcoin to CBDCs, which makes no sense. One is completely decentralized, as I was saying, an asset without an issuer. The other one is the definition of centralization. And with centralization comes, the power to, for example, exclude people from transaction, therefore weaponize the financial system. And it actually even gives more negative incentives, such as the power to take money from specific people or from people in certain circumstances, or to have money that expires. It sounds crazy, but this is actually something that exists already for, I think now 3 years in China. So if you earn 100 yuan, not in all of China, they are doing a pilot. If you earn 100 yuan, you have your yuan on your bank account and you see an expiration date. If you do not spend them within 1 year, well, they disappear. So basically forcing people to spend, in other words, removing your ability to save for the future. You want to save that money for, send your kids to university? Well, forget it. You want to go on holiday next year? Well, forget it.
Buy a home, right?
Or buy a home, Anyway, unfortunately, we are seeing in Europe a very dangerous move towards central bank digital currencies. And some leaders have even praised the Chinese CBDC system, saying how great it is and how it works, which is honestly absolutely scary. To think that you would praise a system of totalitarian control over your citizen in a place that is definitely not a democracy, definitely does not have freedom of speech, and now you give them the power to, if you say something that the person in power does not like, well, we take all of your money. In other words, people will start to self-censor, which is another form of prevention from freedom of speech. And it even goes against all human rights. For example, you have the right to practice your religion. Well, unless you say something that the person in power does not like, because then they remove your money and then you cannot go to, the church, the temple, the mosque, or wherever you want to go to practice your religion. Just take every single fundamental human rights, and they all rely on the fact that you are able to have some kind of way to pay, some kind of way to transact with other people, some kind of currency, some kind of money. If you remove the ability of people to have money, or if you make it conditional, rather, well, then there is no fundamental human rights. So it's not just a monetary question, it's not just a technical question, it's something philosophical with human rights at the core of it. Fortunately, they have seen through this in the US, for example, and they are now passing a bill to make a central bank digital currency forbidden by law, so it will not exist and it will never exist, which I wish that every jurisdiction in the world would go towards, so preventing from putting too much power in the hands of too few, and definitely not putting the monetary system power in the hands of few people, because that's just a recipe for failure. And even if the current administration would be, generous and willing to do the best for a citizen, well, you do not know how the next one will look like and how the next one will look like. The more power you have, the more it's a honeypot for, all the evil people to go and hunt. And eventually you will have a person with bad intentions, or just with a different level of ethics, that will decide to make stuff very different. If you If you decide that you like to buy meat, well, you already bought one steak this month, so I can make the central bank digital currency not work if you're trying to buy steak. If you like to go on holiday, well, I can. We all need to save now, so you can make the CBDC, preventing you from paying for hotel more than once a year.
Whether you are all in on Bitcoin or just getting started, Thomas brought a conviction-driven perspective to where Bitcoin fits in today's financial and cultural shift. This conversation was a reminder that Bitcoin isn't going anywhere. If anything, it's becoming harder to ignore. Thank you, Thomas, for coming today.
Thank you for having me.
And I'm also going to attach the links whether in the description of this video or in my social media posts.